Everything all at once. Oh, there she goes. She started the recording. Okay, great. So we're going to start. So hello, everyone. If you don't know me, I'll introduce myself, Susan Damiani. As we were talking, I am an alumna of St. John's, graduated 1987 from the College of Business Administration. We have these power hours every month. Over the summer, we conducted them in the morning. Now we switch back to our regular time at 1 o'clock. And we also, as you can see, if you're part of this call, you could see we are recording it as well. There's going to be so much great information that I would recommend that you go back to the recording, because I'm sure you'd want to, follow up or double check on all the great facts and information that John Ceparano and Kelly Henning, who are presenters today, are going to share with us. Kelly and John are very good friends to St. John's University. They work at Modera Wealth Management. I will clarify that, like John said, it's not Moderna. It's Modera. John is one of the original founders and Kelly is a principal. Kelly and John are both financial advisors, but John has also the added specialty of being a CPA. So I think that's great because you don't always find that combination. And I think it's very, very helpful, and especially putting together your plans. But this power hour today is Smart Charitable Planning. So we hope you will enjoy it. We are here to answer any of your questions. And if you want more information after you've learned about this, John and Kelly are obviously available. We will share all their contact information. You'll get a follow-up email. But also we have a wonderful seminar at the Garden City Hotel on October 18th called Meet the Experts. I've been here at St. John's for 19 years. I've been offering this seminar for 19 years. It's a very popular one. It's complimentary. And John Ceparano actually will be one of the panelists. We have a whole panel of financial advisor and trust and estate attorneys and so forth. So I'm going to turn it over now to Kelly and John. Thank you.
Thank you. Pleasure to be here. I appreciate the opportunity to try to continue to provide good information for our participants, at St. John's, so that they can make informed decisions. A lot of times when we're given, gifting, while we're alive, when we pass, we're gifting with our heart. Today, we're going to try to emphasize not only using our heart, but our head. As the gifts get larger, there's opportunities that you could take advantage of if you know they exist. And based on your circumstances, different opportunities make more sense at different times in your life. Kelly is going to put up, and we're going to be going back and forth and kind of like in a fireside chat with you to kind of go over these things. So number one, they're understandable, and two, so that you can take some things away and be asking us questions during and after for those that are on today. We call this smart plan giving. And the first thing we want to do is kind of go over what we call a charitable giving circle. Okay. So it all starts out on one, typically, that most people that give to charities are charitably inclined. There are tax benefits that can help out, whether it's income taxes or later on in life, estate taxes, if you've amassed a sizable estate, meaning the size of all your assets. So the first question you have to ask is, when you're gifting, is how much control do you want to have? Well, for the most part, once you make a gift, other than who it goes to, that gift can no longer be retracted for tax purposes in order for it to be tax deductible. So, when the gifts are small and you're going to the grocery store or you're going out and about, and there's a Girl Scout and a Boy Scout, trying to raise money, putting in money, taking money out of your pocket, giving them $1, $5, $10, getting cookies or not getting cookies or whatever is really easy. And those are simple. We're not here to discuss those kind of gifts. We're talking about gifts that are on a larger scale where you're given, 500,000, 10,000, 20,000 or much more. And we want to go over, based on your age, based on where you're at, based on where you have your money, there are a lot of options that you have. So it all depends on the timing of when you want to give things away as it relates to control. It depends on your tax bracket, the way you could gift. It depends on the types of assets you have, whether you have taxable accounts or whether you have accounts that haven't been taxed yet that are still sitting in retirement accounts, such as IRAs, or maybe still in 401ks or 403bs if you work for like the college, St. John's, a non-for-profit. Depending on your age, there are certain types of ways to give. We'll be talking about that a little bit later for such things such as called qualified charitable distributions, which are only allowed to come out of a retirement type of account after you've hit 70.5 years old. That's an important age. Then it depends on the complexity of what you're trying to accomplish. And with complexity comes cost. And the most costly charitable type of planning gets into private foundations. But as Kelly and I will explain, those are usually for people trying to give away $500,000 or more away, and they have a sizable estate, and they're trying to basically save from the government getting their money when they pass away with estate taxes. So when it comes to cost, there's no cost for things like giving things away with a check, or giving things away, even with the qualified charitable distribution. There's no cost to it other than a little bit of time. But when you get up to private foundations, they can cost thousands or tens of thousands of dollars. But most of the things we're going to talk about today, other than private foundations, are very affordable, but it still depends on how much control you want to have. And then in terms of tax efficiency, over the last, I think this is the 4th year, Kelly, I think back in 2018, the tax laws changed. And one of the things that changed was higher standard deduction. It was the government's attempt at simplification. Well, that may have simplified things, but they've made other things more complicated. But we will talk about what they did do. If you're single right now, the standard deduction and you're under 65, is just about $13,000. If you're married, it's just about $26,000, or double. If you're single and over 65, you add an extra $1,400 to that. So now your deduction, so you don't have to itemize and still get a benefit, is $14,350. And if you're married filing joint, it's $28,700. These are very high hurdles for people that in most cases are retired, because medical deductions, you have to have either very low income to get any benefit, because there's a hurdle there, 7.5% of your total income, or otherwise known as adjusted gross income. And for the most part, most people can only take their taxes, their real estate taxes, or if they're still working, some of their state taxes, if they're in a state that you have to pay income tax, as well as their charitable deductions. And maybe if you still have a mortgage interest, it's pretty much limited to that. And for most people, especially if they're single, or definitely if they're married filing joint, it's really hard to get over a hurdle of 26,000 or over 28,700. So you may not get any benefit for some of these charitable contributions. So there's different ways that we can do that. We're going to go over that today. Kelly, can you talk about some of the operational complexities before we go on and talk about the specific charitable giving opportunities?
Yeah, sure. So the last part of the charitable giving circle is operational complexity. So I'll start at the most simple way to give to your favorite charity or charities. You can give them cash, a check, or some even take a credit card payment. Those are the simplest ways that we can help our community. And those are cases, right? You're giving someone, to John's point, $20, $50. These are smaller giving amounts, very easy to give a gift. Kind of the next level of complexity from there is by gifting securities. And what do I mean by gifting securities? So this would be taking an investment that you own in a taxable account, not a retirement account. This is a very important difference. Has to be in a taxable account, and transferring that security to a charity or charities of your choice. This can be done, many charities, you just have to call up the specific charity and ask the way to gift them appreciated securities. This is generally a security that has appreciated in value. So it means that maybe you bought it a long time ago, it's gone up in significant value, and you want to gift that security to charity so as to John's point earlier, take a charitable deduction for the contribution, but possibly also you're giving away a portion of the security that would otherwise be taxed if you personally sold it. Okay, so that's kind of the next level of complexity. After that, we get into something called DAF, D-A-F. That's a donor advised fund. A donor advised fund is a separate investment pool, separate investment vehicle in which you open an account and you give an irrevocable gift to that new account. Once you make the gift to a donor advised fund, you have complete control of where the donor advised fund then can grant the funds to charity. Okay, but once you make the gift to the donor advised fund, you can possibly take a tax deduction in the same year as the deduction. This is just an easy way to, support a charity, but in a way that you don't have to gift to the charity in the same year. So that's a big difference. So the same year you get the tax deduction when you make the gift to the donor advised fund, but then you can send out the money from the donor advised fund over a period of years or period of time. We've seen clients do this, especially when they sell a business at the end of the year. Let's say the business sale is as of December 31st, and they don't want the pressure of having to figure out which charities they want to support on the last business day of the year. So they make this gift to the donor advised fund, and then when they feel comfortable and they identify charities that they want to support, they can gift to them in future years. The next level above donor advised funds is something called a QCD, so qualified charitable distribution. This is available to individuals who are over 70.5 years of age, where they can issue distributions from a retirement account directly to a charity. So the mechanics of this are generally the custodian that holds your retirement account, such as an IRA, will give you a checkbook, and you use that checkbook to issue checks directly to the charity. Okay. The next level up from there, which we'll talk about further, are different types of charitable trusts. So there's a charitable lead trust and a charitable remainder trust. From there, then we jump to foundations. For a charitable lead trust foundation, we're looking at larger sums of money. So we're talking hundreds of thousands of dollars, close to $1 million. Again, with what John was referring to, you're increasing your cost, not only from a management of the trust or the foundation, but also legal and accounting fees. Okay, so again, that's what's important here when you're talking about increasing complexity. You're also increasing the number of parties involved that are going to help you enact this charitable giving. So the next thing we're going to talk about that I alluded to were the different types of charitable trusts. So the first trust that I referred to is something called a CRT, and it means Charitable Remainder Trust. So what this means is it's an irrevocable trust that's created. And what does irrevocable mean? It means you can't change your mind. Once you put this into place, you make a gift, you can't say, oh, the next year, you know what, I don't really want to do this. It's irrevocable. You made a decision to commit money. You put a lump sum, whether it be from a business sale, whether it's securities, into the trust, and then it creates something called an income stream back to the donor. So let's say I put funds into a charitable remainder trust. I can then receive payments for a certain amount of time from the trust. And when I pass away, the remainder that's in the trust goes to charity. Okay, so you kind of solve two goals. One, you're giving to the charity eventually, but I can also get an income stream during my life. I can get either a fixed amount every year from that trust, or I can get a fixed percentage based on the value of the assets each year. You get a current year tax deduction. So that's really the big benefit, would be the current tax year deduction, but it's not a dollar for dollar tax deduction. This is an important thing to remember whenever we talk about charitable trusts, is because I'm going to be receiving a benefit from it and not giving a straight gift, they have to basically prorate my gift. So let's say I gift $100,000 to my trust, but then I get an income stream from it. The IRS says, Kelly, you can't get $100,000 deduction. We need to prorate it because you're essentially getting income from it. Okay. So again, this is something that would be set up in conjunction with your attorney or accountant. because these can be complex and there's a lot of moving parts in it. The next type of charitable trust is a charitable lead trust. So similar to the remainder trust, there is an initial transfer that's put into the trust, whether it's security, proceeds from business sale, and payments are actually made to the charity while the donor's alive. So different than the remainder trust, and then that the charity gets the money at the end. In this case, the charity gets the money while the trust is, working and it's during its life term. Okay. When the donor passes away, whatever is left in the trust goes back to the descendants of the donor, okay, or any other designated beneficiary. So two different types of trust, and it's really a preference on how the donor wants to either receive payments during their life or give the payments to a trust. And I know John has had an example with one of his clients who used a charitable trust. So John, do you want to talk about that client?
Yes, keep in mind, and I think Kelly's, effectively, give me the big picture here is one, these are irrevocable. The decision on whether to go with this usually depends on the size of the donation. This would not be for a $5,000 donation. This may be for well over $50,000 to $100,000. And basically it's to reduce your current year tax if this happens, regardless of whether you're doing a charitable remainder trust and you're getting, money along the way and it reduces that deduction, or a charitable lead trust where the donations are going out every single year. So there's been a number of occasions where these have been appropriate, like when there's a large event, you sold a large piece of property, you had a rental property, you sold the business, whatever that was, it had a large size there. We even had a partner one time that, when he left, gave away some of his money right up front into something similar to this and got that deduction up front when he sold out his shares. The bottom line here is that people are doing two things. They're saving on current year taxes when they go and do this, but they're also taking this money out of their estate. Now, estate taxes have risen substantially per person up to $6 million, but we do have clients that have this kind of wealth, and this is just one of the vehicles to try to do this. And it can add to these things along the way. It's not just a one and done, but you get it when you give it. So that's what I'd like to emphasize here. Now we're going to talk about qualified charitable distributions. Now, the qualified charitable distributions are only applicable to people who have retirement accounts. Now, for those that are older and have already moved their money out of like a company 401k plan or a 403b, okay, into a self-directed IRA, there's no problems because they can do it. They can't do this out of a 401k plan or a 403b. So there's a timing issue there. So sometimes people hold on to these things, the 401ks or the 403bs, because maybe there's a unique investment choice in there where it pays like a fixed interest rate that's higher than you can get outside with bonds. But if you want to do QCDs, they do have to come out of retirement accounts. You also have to be 70 and a half years old. How did they come up with this number? Talk to your congressman. But for today, this is the number. Let's accept it. Okay. And with that, you're able to make qualified charitable distributions up to $100,000 a year. Now, qualified charitable distributions are effective when you can, when you have these IRAs, because what they do is they count towards satisfying your required minimum distribution. So what that means is that if you have a required minimum distribution of $30,000 or $40,000 a year, and you give away $10,000 to various charities, including St. John's, there's my plug, Susan. Okay, and you give that gift to the charities, that money reduces the the required minimum distribution amount. But the key is, and sometimes people make mistakes, if they need more money than their R&D during a year, they need to do their qualified charitable distributions first. So you know how a lot of times when you go to an accountant or a CPA, they say, you need to do this by 12/31, before the end of the year. Well, what I recommend is this, is if you're over 70 and a half, you're charitably inclined, and you have an IRA and you want to do these charitable contributions to these institutions, you should do them in January. Now, when you put money into the qualified charitable distribution, Kelly said it earlier, there is no requirement that you have to give it out right away. It's just that you're never going to get it back because it's irrevocable. So once it goes in, you could give, let's just say that you had a big income year, or you wanted to get a deduction, and you want to kind of bunch your deductions so you can itemize every 2 or 3 years, or when you have a big event. You put the money into, you take money out of that qualified charitable distribution, and you can send it out as you want to. So if you wanted to give it to a church or a school like St. John's, and you put in and you want to give this away, the qualified charitable distribution, you're going to get whatever you give them that year, up to the amount of your required minimum distribution where you get a tax benefit. Okay, so if you have a required minimum distribution of $40,000, and you give away 10 to charities, done operationally correctly, it has to come directly from the IRA, then you will only be paying taxes on the difference, the $30,000. So 70 and a half years old, up to $100,000 a year, and it counts towards your required minimum distribution.
John, can I just add a point about that? I'll just add a point because that's a great example. In John's example, where $10,000 was sent from the IRA to the charities, that is not going to be noted on your tax form when you receive it from the custodian. So if you prepare your own taxes or you have an accountant, you have to account for that $10,000. So when you receive the tax form, it's called a 1099-R. All it's going to show is you had a distribution of $40,000. That form does not show that any money went to a charity and qualifies for this strategy. So it's very important. I know I've seen it missed, John. I'm sure you've seen it missed on tax returns. Very important to notify your tax preparer, or if you personally prepare, to take account for anything that was distributed to charities. It may not be taxable. So
to your point, Kelly, one more thing, what we have done is when we've been involved with our clients doing this, and we always are, when they're they want to do this, they give us the list of their charities, they give us the amounts, they give us the addresses, everything. We send it to the custodian, they send it out. At the end of the year, the reporting, like Kelly says, for the gross amount of your required minimum distribution or whatever you took out. But what we do is we create a letter and give it to the client. So either they use it themselves if they're preparing it themselves, or they give it to the CPA, because the CPA would have no idea because the 1099 doesn't indicate that. So great point, Kelly. Okay, what is the benefit? Well, like I just said, the amounts that you give to the charity from the IRA are excluded. It also will help you possibly reduce the tax on your Social Security. Social Security, the taxable portion of your Social Security can go from 0% if you're in a really low income bracket to up to 85% of your Social Security currently. That's the law. And if you have less income on your tax return, there are thresholds where between, I think it's $32,000 and about $50,000 roughly, where if you could knock down your income on your tax return by these charitable qualified charitable distributions, then you will have less taxable income and it will lower your taxes even further. And you do not need to itemize because this is a dollar for dollar reduction of your required minimum distribution.
The next type of charitable giving we're going to talk about are donor advised funds. So different than the qualified charitable distributions that we were just speaking about, there's no age limit on this. So any adult can create a donor advised fund, and it's a charitable vehicle established at a public charity that enables donors to, number one, make an irrevocable charitable contribution. get a charitable deduction in the same year of the contribution, and then recommend grants over time to qualified charities. Okay, that's the important part that I was talking about earlier, is that you can make a contribution in one year, and then in future years, you can decide which charities you want to give to. We see this work really well when there's pledges to organizations such as the university, right? Some individuals will pledge a certain amount over a number of years. They can consider gifting that entire amount to the donor advised fund and then doling it out each year to fulfill their pledges to the organization. These are relatively easy to set up at custodians. So wherever you hold your IRA account or other investment accounts, it's usually that they have the ability to open a donor advised fund. The cost of these range, but usually it's around 0.5%. So 0.5% is the cost to actually maintain a donor advised fund. Generally, we see people exploring donor advised funds if they're giving, I would say, at least $20,000 to $30,000 a year. If you're giving below that amount, it makes more sense to explore the other strategies that I mentioned earlier by actually gifting securities or gifting by cash or checks.
Kelly, can I make one point?
Yeah, sure.
Yeah. Donor advised funds, different than the QCDs, you know, there's an age thing here. Donor advised funds can be used at any time. Qualified charitable distributions can only happen when you're over 70 and a half years old. Now, when you're giving donor advised funds, and I may have said a couple of things that may have confused you, is that the qualified charitable distributions on a year-by-year basis. It doesn't go into a fund. It's just basically taken out of your IRAs. The donor advised fund is a separate account that's set up, and they charge the 0.5% just to administer all of this. Okay, it's a very inexpensive proposition. And by the way, the larger the amount that sits in the donor advised funds, those fees actually go down. But when you're trying to decide the strategy on using a donor advised fund, they're typically done not year by year. I haven't seen that as much as people get older because they want to get a big deduction. And a donor advised fund, to get a tax benefit, you have to combine it with your other itemized deductions, such as real estate taxes, state income taxes, which is all capped out currently at $10,000 a year, plus maybe medical expenses, if you still have a mortgage, the mortgage interest, and charities. So in order to really get the benefit, you may want to do this every 2 years or every 3 years or every 4 years or every 5 years. We've seen people put into this, you know, $50,000 or $100,000, and there are some limitations on how much you can actually get a benefit from in putting money into, or, you know, to get a charitable deduction. But we usually see this every second or third year when people put money in. So, because otherwise they may not be able to, if they evenly gave out this money, to get any additional tax benefit. And we're going to show you an example.
Yeah, and the other thing to keep in mind are once the contribution's made to the donor advised fund, the funds can be invested. Okay, but we say just be careful about that, because if you have the intent to dole out those funds to certain charities in a short period of time, you really want to keep those funds in cash or some sort of, you know, very, we'll call it safe. We don't like to use the word safe, but something that's not going to have a lot of investment volatility, right? We're seeing that this year, right? A lot of investments are down. You would hate to put money into a donor advised fund and the value of that fund decrease because it's subject to market fluctuation. So again, just be careful with the investment selections on these type of funds, because there are a lot of variety in terms of what investments you can choose from. Okay. Now we're going to give some examples. So John's going to outline a scenario for Andy and Amy.
Yes. All right. There's always couples out there. It could be single person. We happen to use some couples here. Andy and Amy are married. They're both 75 years old or older in this case, in 2022, and they retired with 1 adult child and 3 grandchildren. They typically donate $25,000 a year to charity, and Amy and Andy's objective is to see their gifts in action during their lifetime, not when they pass. What should they do? So we're going to go over an example with numbers on what would be the most beneficial type of charitable option they have.
So in this column, you can see that Andy and Amy give $25,000 directly to the charity. All the numbers here aren't overly important. I'm going to highlight a couple to show you where the differences are in the bottom line, right? And what's the bottom line? How much you pay in taxes, right? That's the important part of thinking smart about these strategies, is reducing your taxable income. So this is the example. In this case, Andy and Amy give $25,000 directly to the charity. As John mentioned, because the standard deduction has risen so much, really since 2018, you can see if they were to take a standard deduction, it would be $28,700. By gifting directly to charity, their itemized deductions go up to $33,450. What does this matter? All it means is they're not getting the full benefit of giving $25,000 to charity, because they're already going to get the standard deduction of $28,700. So they're really only getting, you know, $5,000, $6,000 of additional deductions in this scenario because the standard deduction is so high. So you can see their total tax bill would be roughly $16,000. If they used the qualified charitable distribution charity or qualified charitable distribution that we talked about earlier, this type of strategy, you can see they reduce the amount that's coming out of their IRA, right? So in this case, they took out $54,000 of their IRA money and they spent it fully taxable. Here, they used $25,000 of their IRA distributions to give to charity, okay? And they took the standard deduction because their itemized deductions were so much lower, right? Because they took the money from their IRA rather than just giving the charity money from a taxable account or from their checking account. Because they did the qualified charitable distribution, they saved potentially $4,400 by just shifting how they gifted the money to the charity. Okay, so this is just a real life example of a way that, in this case, a couple over 70 and a half can adjust their giving to, you know, decrease their tax bill.
Kelly, just one point, only because I've been on both sides of the fence. I've been the CPA and I've been the CFP, you know, the tax preparer and the financial advisor. I happen to know about this because I was very interested in this from education, St. John's, continuing education, and I realized all this. But a lot of times there's a major disconnect between the CPA and the financial advisor. The financial advisor in many cases is not a tax expert, and the CPA is not an investment expert. And the CPA, to their defense, usually wind up seeing these things happen when it's too late, while the client has not actually sat down with the tax preparer to explain to what they're trying to accomplish, and they just take the numbers like an historian and record column 1. That's what happens a lot. So having an advisor that understands the tax law and can communicate with your accountant, CPA, or even you individually, that's how they get the benefit of these QCDs, is people understanding the nuances and how with the same exact deduction, you can save an extra $4,400, $4,500 if you were using these numbers. So what does that mean to you? It's not just a tax savings. You can do more with it. Because to me, what happened in column 1 was the IRS became one of your charities. And that's sad, because you're entitled to get the benefit by just learning about the QCD. So hopefully this is helpful today.
I have a question about that. Would a financial planner perhaps look at, while looking at their age, that it might be beneficial to keep that money in a tax deferred account, depending on what that's paying, that may be a better benefit than what they're saving in taxes? And that's assuming they're not even up to RMD age, especially with the new proposal that it might be 75.
Okay, so let me make sure I understand the question. So first of all, we're talking about an age under 70 and a half.
Well, it could be 70 and a half, just somebody not subject to RMDs.
Oh, okay, so they don't have an IRA then.
Well, they have an IRA, but pretty soon it may be 75 may be the age that you have to take out.
Well, actually, currently, it's a little confusing. You're still able to give out qualified charitable distributions right now if you're 70 and a half.
Right,
The current age to take out RMDs has switched to 72. So some people have
Right.
been grandfathered into the 70 and a half. So if they had already started before the law
Mhm.
changed, they can continue doing it. And now they're past 72 anyway, probably. So whether it's 72 or 75, whenever they get there, that QCD using these numbers would be beneficial. If somebody had investment income, and this is assuming that people with our type of clientele, we reduce it as much as we can on the investment side. In other words, they didn't have all their money in IRAs and they had money in the taxable income. And your question relates to the difference, the net benefit difference between a corporate bond and a municipal bond, which is where you get tax exempt interest from. Right now, the spread is greater after taxes, and it still makes sense to have corporate bonds. But a lot of times the design of people's portfolio, which is really not part of this presentation, is to have the corporate bonds inside your retirement accounts because they're not going to get taxed anyway while it's still in the IRAs. And whatever is in the IRAs is ultimately going to come out and be taxed at the highest tax rates. For tax exempt income, we would put in taxable accounts. So it depends on people's circumstances and depends on the difference on what corporate bonds make versus tax exempt.
Okay, thank you.
You're welcome.
So we're going to do another example. In this case, this is a 65-year-old couple. So John, do you want to walk us through this example?
Yes, they always have these really handsome looking couples in these pictures, by the way. So anyway, John and Janet are married, both 65 years old with no children or grandchildren. They're passionate about supporting charities and they serve on the board of the ABC Foundation. They give $10,000 a year to charity and upon passing want to give $50,000 to charitable causes. John and Janet's objective is to help local charities within their budget. What should they do? Well, the first thing we know here is that they're not 70 and a half years old, so they can't currently take a qualified charitable distribution. So the question is what are their next best options based on the dollars they're trying to give away?
Right. So in this case, you can see there's several columns here. And similar to the last example I talked about, it's not important to know every single number on this slide, but we do want to illustrate the differences in what's called bunching of charitable contributions. Right. So as John mentioned, John and Janet want to give $10,000 to a charity each year. Okay, so this is column one, is where they just give $10,000 to charity each year as they've been doing. And you can see here their total tax over, in this case, we picked a 4-year period, is roughly $45,000. Okay.
And what's important to note there, Kelly, is that they're taking a standard deduction, which means to us is that they probably didn't have high mortgage interest or any, and they didn't have high real estate taxes combined, because if it's 28.7 and all you can get for tax deductions is 10, they couldn't get over that hurdle. So they have to take the standard and effectively got no benefit, additional benefit for the charitable contributions.
Right. And then option two, they decide, okay, instead of doing $10,000 a year, we'll give $20,000 every other year. Okay. So in this case, as John mentioned, they've gone over the standard deduction. So they've taken advantage of a portion of the contributions that they're making, but only $33,000 in itemized deductions. Okay, so they're saving some tax over 4 years, right? About $1,900 in taxes. It's some tax savings by doing every other year to the charity. But the best way for this couple to reduce their taxable income is to actually do a one-time $40,000 gift to the donor advised fund. The reason for that is that you can see 1 year, the $40,000 goes directly to their itemized deductions, and they can see a reduction in their income of close to $3,700. This goes to the concept, like I said, of bunching your contributions into 1 year. What this means is you're just getting a bigger bang for your buck tax-wise, because you are getting your itemized deductions increased by giving a large amount to a donor advised fund rather than splitting that up over a 4-year period. Okay. So this is why, to John's earlier point, it's important that if you work with an advisor, if you work with an accountant, to loop them in at the beginning of the year and say, look, this is what we want to do. These are our charitable goals over the next several years, even later in your later years. And they can help you come up with a strategy, because it may be something where you say, look, I've done this every year for 20 years. I want to continue it. And we may say, great, you could continue to do that, but you might want to front load it, put it in your donor advised fund, and then give out money each year. So again, tax efficient way. Oh, go ahead, Henry.
What's the difference between the donor advised fund and just saying every 4 years, I'm going to give $40,000 to the charity?
You can definitely do that. You can do that. Yep. You can give the $40,000 directly to that charity. To my earlier point, if you made a pledge that you want to fulfill every year, so you don't want to give that lump sum, you can put it in the donor advised fund and they can dole it out over the 4 years. So yes, you can definitely give the $40,000 one-time gift.
Yeah, and by the way, in a donor advised fund, you don't have to give it to one charity. It can be multiple.
Mm-hmm.
On numbers here, before we jump to the next, and I think it's the last slide, what you can't see here, and we maybe should have done this, but we don't want to always have too much information on a slide, is if you look at the taxable income line on this slide, it goes from 91.3 to 87 to 67. I know intuitively, because I look at this stuff, the $87,000 mark, or maybe 88, is right on the brink of going from the 12% bracket to the 22% bracket. So when you're able to go from column 2 to column 3 there and go well below that 87, 88,000, you've now each additional dollar above whatever that cutoff line is going to save people an extra 10% in taxes. So it's huge when you know the tax bracket of your clients. So I have some clients where these numbers are double and triple these numbers. And when you're going from 12% to 22, that's huge. When you're going from 22 to 24, it's not a big deal. But when you go from 24 to 32, another big jump. Knowing these brackets and knowing what people, how people are charitably inclined, and knowing when to do these things and plan way ahead, not after the fact when you show up and drop off your proverbial shoebox to your accountant and stuff, and they go, why are you bringing me all this garbage, right? Hopefully you're organized and saves you a little bit of money on prep. This can save you a lot of more money. And I'd rather sit there doling out money like Rockefeller, on a park bench, helping out people go get ice cream cones and give it to the IRS. So this kind of planning really helps out for these people who in many cases don't know who they're going to do it, or want to get it out of their estate. So there is a reason, Anne-Marie, on why people do this opposed to every 4 years. Sometimes they have large estates and they want to get it out of their estate as soon as possible, or they want to get it out of their estate so it doesn't go to beneficiaries beforehand if they pass away. There's a lot of, personal circumstances.
The other point that John made about donor advised fund, right? You can pick a number of charities that you want to support. We often see clients sit down with a loved one and decide which charities that they want to support. So you can kind of make it a family event, at a certain point of the year and say, what causes, what charities are you interested in? And kind of bring the next generation in with you to support your original charitable giving goal. So again, we like, children, grandchildren, nieces, nephews, how can I help you support your charitable organization? It's a great way to, like I said, get family involved.
Yeah, while children are charitable, they're not deductible. So, I just want to clarify there. The big, one of my biggest enjoyments is, we help clients for years. Kelly and I have been doing this for a while now, me a little bit longer. I'm like your big brother, we'll go with that. But the point is that one of my favorite things is clients calling me up and saying, John, what's going on in the community? Who needs money? Now, I don't get those calls all the time, but I get about 5 or 6 clients that ask me that. And I say, what's important to you? And really, at the end of the day, this whole conversation is about giving excess cash that you don't need or don't want going to heirs, or they don't need it. And you want to get it to them in the years or in the way that you can retain more of it. So you either could spend more of it yourself or help others. And that's what you're doing by doing this. We're just trying to help you find ways to stretch the dollars to get to the people and organizations that could benefit from the most. So in summary here, there's a lot of factors when we start out, and this is just going over the same thing here, but if you're under age 70 and a half, we recommend using a donor advised fund. Or if it's smaller amounts, you can just give direct checks if you can itemize. If you don't have enough money all at one time, you may not be able to do anything about it. But if you do, and you have the access to the resources to be able to do it in more in lump sums and bunch your deductions, donor advised funds is a great vehicle. 70.5 years old plus, use your qualified charitable distributions first. Even if you wanted to give more than 100,000, use those first, because dollar for dollar, it will reduce your income and it'll save you on taxes. Large contributions, and you need the income one time or ongoing, as Kelly explained earlier, you can use a charitable remainder trust. And large contributions that you don't want the income but want to leave the money to heirs, you can consider a charitable lead trust. The big takeaway here is, this should be all part of a comprehensive plan. This isn't something you wing it, especially when you talk about with larger dollars here. And when you're talking about institution and coordinating things, it should be part of talking about your estate plan, as well as your current and longer term income tax planning. One of the things that's very important to note is if the tax laws don't change and they continue on as they are, in 2026, all the current brackets are expected to revert back to pre-2018, I think it is, rates. And that means a 12% bracket, and all the brackets will go up by 3%. So 12% becomes 15, 22 becomes 25, 24 becomes 27, 32 becomes 35, and so on and so forth. So your unique circumstances and the timing of when you can or want to give this away should be looked at in a larger picture. Do we have any questions from Paul or Amory who are on the call?
I have a question.
Okay.
If your estate, I mean, it's for a lot of people, it's easy to be below the federal estate tax level. But if you're above, if your assets are above the state estate tax level,
Right.
and you have an IRA or 401k where the beneficiary is a charity, and if you die and that entire account is going to charity, the charities you've picked out, does that reduce your estate tax state level, or you still stuck? You owned it when you died. It's after you died, it went to charity.
No, Paul's shaking his head and I agree with him. It's not going to be taxable. And keep in mind something too, that's on retirement accounts, and beneficiary designations are very, very important here for a purpose of what you just brought up.
Yes.
And I don't know about anybody in the call, but we've had couples come in, and you find out as you have the conversation that it's a second marriage. And we've got ex-spouses, husbands and wives, still beneficiaries that they really weren't thinking about. So working with your estate planner and working with your financial advisor, these things should be kept up to date. People die, people come into your lives, and now you want to add on. People go out of your lives. People are too far away. They don't talk to you anymore. We always kid around and go, has anybody ticked you off this year? Is there any reason to change any beneficiaries? And in some cases there are. Babies are born, grandchildren, there's all different reasons. So beneficiary designations are critical for purposes of estate tax purposes, especially at the state level, because some states have much lower exemption amounts and you'd still be liable for estate taxes. So it's a very good question, beneficiaries.
But I want to understand the answer. So if somebody's like, let's just say the state has a state tax level of 200,000, and your estate is worth 250,000 when you die, but you have a 401k or an IRA, and the beneficiary designations are clearly for charities, and everything over that 200 is in that 401k plan that you're giving to charity. Does that bring you for estate tax purposes under the $200,000 level? Or do they look at, look, you died, doesn't matter, you're giving it to charity, you died with assets above the estate tax, the state estate tax level?
No, your beneficiaries will dictate that it's going to them and it never passed through the probate process. Correct, Paul?
Yeah, let me maybe help Ann.
Yes,
There'll be a
please.
requirement to
He's our
file,
special guest, by the way.
that you'll be required to file, the estate will be required to file a state tax return,
Yes.
but it gets the full charitable deduction.
Right.
So there was zero tax. That's the only difference.
Okay, that's good to know. So if you have a big 401k plan, but you're over the estate tax level,
Mhm.
and giving that retirement account, that fully taxable retirement account, clearly to charities, it's going to bring you down.
Yes.
Yes.
Thank you.
Yeah, and that's really smart planning too, by the way, Anne Marie, because there were some law changes at the end of 2019. Flew under the radar because it was really the early days of COVID, so it didn't get much press, something called the Secure Act.
Mhm.
So if a qualified account, such as an IRA, 401k, passes to a non-spouse beneficiary, there's some nuances on that if someone's disabled, if it's a minor child,
Mhm.
but it got rid of something called the stretch. So what
Oh,
that
yes.
means is, let's say my children receive my 401k and they're over age 21. They're forced to take the money out of their IRA or out of that IRA over 10 years. They used to be able to spread the money out and take a little bit out each year. Now it's got to be out within 10 years. So from that perspective, as well as, just the taxable distribution aspect of an IRA 401k, very smart to use those to gift to charity as opposed to a taxable account,
Right.
which we see a lot of new clients come to us and in their wills, they've broken down, I want X thousand to go to this charity, X thousand to go to this charity, but they have a large retirement account. And we say, well, let's rethink your goals here. How much do you want each, whether it's a charity, family member to have? And let's find the most efficient way to do that.
Yeah, if you are an heir, your favorite thing to get when you're getting an inheritance is a Roth.
Oh, yeah.
The next would be a taxable account, because on the day the person died, if they were to take that money and go to sell it, a security or something, they would pay no tax, because what they get on their current tax law is a step up in basis up to the fair market value. So if the current value is $1 million and you only invested in it 500,000 because you've had it for 20 years or so, or whatever it is, now it's considered no gain on that day. If it goes up or down after that, then you'd have to be gain or loss on that, but that would be next. The last one somebody wants to receive is an IRA, because they still got to pay tax on it when they take it out. So they do have up to, under current law, 10 years to take it out of that account. Not a spouse. Spouse gets to take it over as their own and wait until, their own R&Ds and everything else. They can choose that. But a non-spousal beneficiary, they would like Roth first, taxable account, IRA last. So that's why, to Kelly's point, and yours effectively, Anne Marie, IRAs are the best vehicles to gift away first.
John and Kelly, you didn't mention charitable annuities, gift annuities.
Yeah, Kelly.
No, that is another option, Paul. With rates rising, right? We talked about that at the beginning before we even started the presentation. I think things are changing a little bit, depending on what the federal rates are on the applicable interest rate on those types of gifts. But yes, that is another thing to consider, similar to remainder trust, foundation. We see those for larger sums of money. Those are another.
In fact, I have given St. John's money
Yes, you
for
have.
gift annuities. In fact, I'm going to be probably doing it again this year, because with the stock market down, I converted some of my traditional IRA into a Roth, which means I'm going to have to pay the taxes on that.
Right.
However, by making another gift annuity, St. John's, I'll get a relatively big deduction to help offset that. So that's a little bit of a device in this deflated market that we have now.
Can you explain that a little more? How?
Well, by giving a gift annuity, by let's say I
We're
gave
gonna
St.
have to
John's,
pay Paul for this call now. Thanks, Anne Marie. But I'm gonna let him explain. I can explain it, but he'll explain it.
if I gave $100,000 to St. John's,
That's right.
I would get a immediate charitable deduction equivalent to the presumed value going to the charity ultimately. So in a rough rule of thumb, at my age, the charitable deduction might be something like 60%. And so 60% of that 100,000 would be deductible on my income tax return, subject to the limitations. But I would then get approximately 8% a year for the rest of my life. And I've designated the balance to go to a scholarship fund at St. John's. So I like that, particularly with the, as you know, with a Roth, you don't have to take minimum distributions. With a regular IRA, you have to. So by getting it into that Roth, hopefully there'll be more left over because they don't have to take distributions on it.
What's
Yeah,
your,
just to take it a step further, and then when when the gift is solidified, St. John's draws an agreement up, and both sides sign it. Right now, our financial institution that we use to manage our gift annuity program is State Street, and they handle all the reporting. So they would send the, the tax, the 1099 or whatever, they would send that to you. And also what we do is we do quarterly payments. So they would send quarterly payments to you for your, for your lifetime. Obviously, if it's a 2-life annuity, the rates are a little slightly lower than on a immediate single life. And then obviously, depending on your age, you could defer it as well. And when you defer it, those rates are much higher. We've seen activity, and obviously the activity started to diminish as the rates went down. But as rates are going up, I could see more alumni probably calling me, which is nice, Paul. I can't wait to get a call from you. I'll be glad to process that annuity for you. But it is a great gift. And usually I will say we're very successful with our annuity program, that people tend to live longer than they were expected to live. So, but that does have an effect on the gift, obviously. But we usually say about 50% of what the original gift is what St. John's would most likely get. And you can designate, where you want that gift to go to. Paul has it going to the law school.
Yeah,
And
Paul,
it's not,
it
8,000 is not
effectively
totally
works like-
taxable. It's taxable at increments because you're getting a
Yes.
return of capital. So it builds up while you're getting it. And if you outlive your life expectancy, then it'll be all taxable income.
And
Yeah.
obviously the rates change. So maybe we have a discussion today, and then you think about it and you come back to me 6 months, the rate could be different. Now, if it's within a 3-month period, I can take the higher rate out of the 3 months.
Yeah, it functions very similar to a charitable remainder trust account.
Exactly. Yeah. It's a little
That's why we
simpler.
didn't get into all the nuances, or we would
Yeah.
need another hour.
I know. No, it is. No, you're absolutely right. And it is simpler. And sometimes we can even run it. We call it running an illustration for you, where we can show you the comparison of would a trust or the annuity, which one would be beneficial to you. And obviously, we always, encourage you to run that past your CPA and financial advisor.
So please feel free to reach out to us, with any follow-up questions. This is an area that I do a lot of work in, and so does Kelly. And our firm is focused on helping, as people do well and are charitably inclined, they want to come up with plans that work best for their circumstances, and everybody's unique. So,
Yeah, well, thank you so much, John and Kelly. I think I had said this to you when we were doing the test run. I think it's a great summary. It was short and to the point, but still very informative, because sometimes it is hard to digest. If you're not in the business, it's very hard to digest all the different types of vehicles. But that's what this Power Hour is for, is to provide valuable information and to educate our alumni on different subject matters. And obviously this is an important one. We have a very generous donor like Paul on the call, and we really appreciate alumni stepping
you.
forward and really supporting their alma mater, because we couldn't do it without, our donors. It's how the institution continues to flourish. But one last thing, if I can end on this note, what we talked about was highly, technical. It was on the technical side. My approach here really is not one. I know as a fundraiser, I'm always called the professional pickpocketer. And sometimes I giggle when I hear that, but to tell you the truth, as I progress into my career, I'm starting to take offense to it, because that is the last thing of what I do and my approach. What I have found over the years of people that really come forward and really truly want to help the university, it's not only getting a tax benefit, whatever benefit you're going to get at, hopefully you will. I mean, we all want people to benefit in whatever they do. And if it's a two-way street, you benefit in St. John's, terrific. That's a win-win situation. But, we are a Catholic university, so I'm going to get a little spiritual with you. You make these gifts, really, I have to see, it's amazing the impact that it makes on you personally and spiritually. We know that we don't live forever. And I even had said to my mother yesterday, as the Queen eloquently, we did this, the English did a wonderful, eloquent send off to the Queen. And I said to my mother, but look, at the end, she didn't have the jewels. She didn't have the crown, nothing. She went out the way she came in. Right. And so we can't take it with us. And I know we have our family to support, and certainly they come first, and St. John's feels that way. But, someone said to me once, you look at it this way: your children or whoever your beneficiaries are can get 100%, or they can get, less than, 95% or 98%. Are they really going to miss it, where that percentage you can give to a charity and really make a difference for so many people and make an impact on society? We're all here to help each other. And when you do that, I'm telling you, personally and spiritually, you will get so much out of making a gift, not just for St. John's, for all charities. And it's not only because I work for a charity. I really believe that. And I see, I see it. I see how it transforms people and makes them feel really good about themselves. And that, for me, as a fundraiser, that's what I want to do for you. I want you to feel good about what you're doing, because when you feel good, then we feel good, and everybody is being helped by this wonderful act of kindness. So hopefully everybody who's not even here today that's listening to the recording, I hope you will really think about that seriously, and then give me a call, because I'm happy to talk about it with you. So thanks again for this wonderful afternoon. Anne Marie and Paul, thanks so much for joining us. I hope you got a lot out of it, and in any way I can help you, like I said, please give me a call. Thanks again.
Thanks,
Thanks,
everyone.
Susan.
Thanks for having us.
John. Thanks,
Thank
Kelly.
you.
Bye-bye.
Bye-bye.
Bye, everyone.
Bye-bye.
Bye-bye.